Hey guys, welcome to another video with Wallet Insiders. And in this video, we're going to be talking about saving versus investing and which is right for you. So, we've always been, for the past few videos, speaking about how to invest your money, how to invest your money in this, how to invest your money in the stock market, real estate. Um, but we've never really explored the option of saving versus investing and if you should even invest at all. So hopefully by the end of this video, you have a better idea of exactly what you want to do, if that is saving or investing and why. So let's jump in. The explanation of the difference between saving and investing. When it comes to personal finance, saving and investing are two key concepts that can help individuals achieve their financial goals. While they are often used interchangeably, for God knows what reason, saving and investing are not the same thing. Saving specifically refers to the act of putting money aside for future use. This can be done in many ways, such as putting money into a savings account, a money market account, or a certificate of deposit or CD. Savings are typically low risk and offer minimal returns, but they provide a safe place to keep money that will be needed in the short term. As we could see from previous videos, once we make the connection, we'll see that lower risk usually means lower returns. And whilst every option may have their own spectrum of high risk, low risk, and high returns with low returns, um, that's generally the rule of thumb. So obviously with savings, because it's just a saving and not an investment where you expect your money to just grow exponentially, the risks are generally lower. On the other hand, investing involves putting money into assets that have the potential to earn a higher return over time. Examples of in like investing or investments include stocks, bonds, mutual funds, and real estate. Investing carries more risk than saving, but it also has the potential for greater returns. Yes, high risk, high returns, etc. The importance of financial planning is another thing that you'd have to explore. Now, it doesn't matter whether you choose to focus on savings or investing, just for the purpose of life itself, it's important to have a financial plan in place. Okay, a financial plan is a roadmap that outlines your short-term and long-term financial goals, as well as the steps you need to take to achieve them. That's very important. Okay, they help you to make better decisions about how to save and invest your money. By identifying your financial goals, you can determine how much money you need to save and how to invest your money to achieve those goals. All right, you don't want to think about, okay, I just want to invest, I want to invest, and then your investment or your savings is paying you off 10 years down the road when your financial goals that you have to meet are 5 years away. Then that's going to just cause trouble for you. You're going to have a lot of problems moving forward, and that is why financial goals are so, or financial plans are so important. Additionally, they can help you to prepare for unexpected expenses for life events. For example, if you have an emergency fund set up as part of your financial plan, you will be better equipped to handle unexpected expenses such as job loss or a medical emergency. I mean, just look at COVID, so many people lost so much, and there was no financial plan in place to handle those unexpected expenses. And some people ended up out of a job. Some people ended up getting COVID and then having to be housed, which took a lot of money and put them in debt. While some people actually thrived because they would have had that savings there, and some might have taken it to even start businesses that were necessary during COVID that we didn't even think was something that people would get into, you know. So it's definitely better to have that plan in place. So now let's explore the basics of saving. So when we say saving, what do we mean? Well, saving is the practice of putting aside money for future use instead of spending it immediately. This can be done by reducing expenses, increasing income, or a combination of both. The primary purpose of saving is to build financial security and stability for oneself or one's family, right? So now we look at different types of savings accounts. There are several types of saving accounts available, but each with its own features and benefits. Some common types of saving accounts include the traditional saving accounts. Traditional savings accounts are the most basic type of saving accounts. These accounts typically offer low interest rates but are insured by the Federal Deposit Insurance Company or the FDIC up to a certain amount. You then have high yield savings accounts. High yield saving accounts offer higher interest rates than traditional savings accounts. These accounts may, however, require a higher minimum balance or limit the number of withdrawals allowed per month. Moving on from that, we have money market accounts. And they are similar to traditional saving accounts, but typically offer higher interest rates. These accounts may require a higher minimum balance and limit the number of withdrawals allowed per month. Then we have the certificate of deposit, CDs, which are time deposits that offer fixed interest rates over a specific period of time. Typically, they offer high interest rates or higher interest rates than traditional saving accounts, but they require a minimum deposit and may impose penalties for early withdrawals. So when you hear us speaking about interest rates, usually with savings accounts, what you do is that you put your money into a bank or organization where they have these accounts set up for savings, and you get a return or an interest rate back on the money that you have invested. So if they're offering a 4% interest rate and you deposit $1 million into that, just saying, just for example purposes, you get 4% of that million back to you, you know? So that is what we mean when we say interest rates, not you paying that interest rate. Just want to clarify that, right? So the reason why you would see that the higher, the banks or the accounts that offer higher interest rates, they are usually the ones requesting that you have a minimum a minimum balance or limit put into the bank account or into that savings account. So, for example, you may find that the traditional bank account may have a 0.5% interest rate on the money. So, you can definitely put in whatever amount you want inside there, and you would just get a very small return on that money every year. However, you could put it into something like a money market account where the interest rates are much higher, could say at 4%. And for example, if this was $1 million we were talking about, because you have to put more money into those accounts, exactly how much depends on whoever is running that account, whichever institution or bank. But you could get 4%, which could be $40,000 per year that you're just making passively off saving, you know? So there's less risk in saving, yes, but according to how much you want to make, you actually have to be able to put more out there to get more back, right? So pros and cons of saving. Some of the pros of saving are building an emergency fund, like we said before. It allows you to build an emergency fund to cover unexpected expenses or loss of income. Achieving financial goals is another pro, such as buying a house, paying for college, or starting a business. which we explain as well. Some people starting businesses out of COVID, taking the opportunity to do so. And then we have building financial stability. Saving can help you build financial stability and security for yourself and your family. So now we look at the cons of saving, because everything that has pros has cons, and we see that they have low returns. Savings accounts typically offer low interest rates, which may not keep up with inflation. So we have to keep that in mind, right? And that can be um, better explored by using your financial plan, seeing exactly what you really need to get back in order to meet your goals. So then we have limited liquidity. Some saving accounts may limit the number of withdrawals allowed per month or impose penalties for early withdrawals. Again, your financial plan would help you to discover when you need to meet your goals. And so before you take the time to create these accounts and put your money in there to then get penalized for taking it back out, you know that, hey, I have this amount of time to get to my financial goal, and this is the amount of time that I have to wait before I can take my money out. Do they align, or do I need a new plan? Things like that. That's the importance of those financial plans, right? So opportunity cost is another one. Money saved in a low interest savings account may not be earning as much as it could if it's invested in a higher yielding investment option. So now let's look at the basics of investing. Because if we finish talking about savings, now we want to know what exactly investing has to offer. So let's see what investing is. It is the process of using your money to purchase assets with the hope of generating profit or income in the future. It is a long-term strategy that requires patience, discipline, and a willingness to take on some level of risk. While there are many different types of investment, the goal of each is the same: to earn a return on your money. That's all you want. You want to make these decisions so that when you take the money that you've spent your time and the energy earning, that you can get something back out of it instead of just losing it all. There are obviously different types of investment options. So each has its unique characteristics, risks, and potential rewards. So let's look at the most common types of investment options. Stocks. At least once in your life, you've heard about the stock market and stocks. You may not know exactly what it is, but it's a very popular option for investment. So when you invest in stocks, you're essentially buying a share in a company. Stocks are considered to be one of the riskiest types of investments, but they also have the potential to generate high returns over time, which is why the stock market is so popular. It's really a make or break kind of area where if you invest and you can get rich in no time, but you can also break your bank and really suffer a hit um, on your finances. So you really need to be careful about that. Then we have bonds. Bonds are essentially IOUs issued by companies or governments. When you purchase a bond, you are essentially loaning money to the issuer, who will then pay you interest on that loan. Bonds are generally considered to be less risky than stocks, but they also offer lower potential returns. And though we speak a lot about risk and about returns and these kinds of things, but all of these investment options, they usually have their own spectrum of risk and returns. So we may say it's less risky than stocks, which it probably could be, but there are some stocks that offers better security, and there are some stocks that offer lower security, while in bonds as well, their own spectrum exists where some companies may be higher risk and then because of that offer higher returns, and then you have lower returns but much less risky when you go with like government bonds, because the government can't just up and disappear and liquidate itself in a matter of weeks, right? but companies do it all the time when it is they don't do so well and they have to leave the market. So really, they have their own spectrums. We then look at real estate. Investing in real estate can take many forms, from purchasing a rental property to investing in a real estate investment trust or REIT. Real estate investments, they can be lucrative, but they also require a significant amount of capital and come with a high level of risk. And one thing they don't mention here is also time. Real estate takes a lot of time because it's something that you generally have to keep up with throughout the process. From the time you see a property, you have to start researching on it, um, its location, how it looks in the market. Will it rise? Will it fall? Is it a good investment? Then you have to look at remodeling if you need to do that, keeping up with the contractors who are on the job to make sure that they do what they're supposed to do the way that you want it done. And then if you're renting it out, especially, you'd have to keep up with tenants and obviously carry out routine maintenance on the place. So time is a very big factor as well in real estate, right? Let's move on to mutual funds. Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, and other assets. They are considered to be a more conservative investment than stocks, but they also offer lower potential returns. You're basically coming together with these individuals. Gary says, okay, listen, I want to invest in stocks here. Peter says, okay, great, you're doing that. Well, I'm going to do some real estate. So John says, okay, so you guys are doing that. Great. Well, I'm going to get a government bond. And they all put their money together. They secure these. So now it's not just one investment, but three. But the money is pooled together to do it all. And so the investments are then equally split in that way. A diversified portfolio means that all your eggs aren't in one basket. And should one fail, there are so many backups to consider. So definitely it's a great option, but like they said, it's less risk. So obviously it's less returns, right? Then we look at exchange traded funds or ETFs. They are similar to mutual funds in that they pool money from multiple investors to purchase a diversified portfolio of assets, but they trade like stocks on an exchange, which makes them more flexible and easier to trade than mutual funds. We're definitely going to do a video with ETFs because I think that it's so much to benefit from, and a little information goes a long way, especially when you're making these life-changing decisions. So look out for that. Now, obviously, we reached to the point where there are the pros and cons of investing. That one place in the article that really makes you question, should I really? So let's take a look and have an open mind. So some of the pros of investing include the potential for high returns. Investing has the potential to generate much higher returns than a savings account over the long term. Diversification, which allows investors to spread money across a variety of assets, helps to reduce risk, and that is something that we can do with investing. We also have inflation protection. Investing in assets that generate returns above the rate of inflation can help to protect the purchasing power of your money. Okay, the scary part now, let's look at cons of investing. Stay with me. We have risk. We know that all investments come with some level of risk, and it is possible to lose money when investing. This is why we take the time to put things in place, do risk assessments, get our financial plans done so that we can embrace those risks from a more comfortable standpoint. You don't want to take risks when you don't have anything put aside. You have money for rent every month and money for food, and risking that money means that you don't eat or you don't sleep somewhere. And that's too much of a risk. So we definitely want to assess how much we can risk so that should it be lost, hope is not lost, right? So, time commitment. Investing requires a long term commitment and it can take time to see returns on your investment. Again, financial planning, right? Complexity. Investing can be complicated and it requires a significant amount of knowledge and research to make informed investment decisions. So we need to keep those things in mind. All of these here, as long as you do that financial plan, these cons become minuscule because you know you have to put time in, and the complexity is something that can be um, basically mitigated with research and knowledge, which is all on you. The only thing really here is risk. And once we know that we can take a level of risk and potentially earn, it's really not that scary. Now we go to the differences between saving and investing. Risk versus reward. When it comes to saving and investing, one of the most important concepts to understand is the relationship between risk and reward. Okay? Essentially, the higher the risk you take on with an investment, the higher the potential reward, but the higher the potential for loss. That is why it's important to carefully consider your risk tolerance before investing. Okay, let's not forget that. Right? Savings accounts, on the other hand, are generally considered low risk. While the return on investment may not be high, there is very little risk of losing your money. Savings accounts are also insured by the FDIC, which means that if your bank were to fail, your money would still be safe up to a certain amount. So there's no way, no matter what you're doing, to just absolutely get rid of the risks. That's not going to happen. But, as long as you can identify your risk tolerance, you'd be operating from a much more comfortable standpoint. The time horizon. Another factor to consider when deciding between saving and investing is your time horizon, or in other words, how long you plan to keep your money in an account. Short-term goals such as saving for a vacation or a down payment on a house are better suited for savings accounts. This is because you'll need access to your money relatively soon, and you don't want to risk losing it in the stock market. For longer term goals, such as retirement or saving for a child's education, college, investing may be a better choice. This is because you'll have more time to ride out any ups and downs in the market. And historically, the stock market has provided higher returns than saving accounts over time. So, you just really need to take that into consideration. Okay, time is money, yes, but once you figure out your financial goals, you'll have a much better idea on your time horizon. Next, we look at liquidity. Liquidity refers to how easily you can access your money. Savings accounts are generally considered very liquid. You can withdraw your money at any time without penalty. Obviously, that depends on the account that you decide to choose as a savings account, but generally, there is little to no penalty. This makes them a good choice for short-term goals and emergency funds. Investments, on the other hand, are less liquid. Some investments, such as stocks, can be sold relatively quickly, but others, such as real estate, can take much longer to sell. This means that if you need your money quickly, you may not be able to get it out of an investment without taking a loss. So that money once you're investing, you need to really have money that's going to put aside for a long time that you're not going to need to touch. Return on investment, or ROI. Finally, when deciding between saving and investing, it is important to consider the potential return on investment. Savings accounts typically offer very low interest rates, which means that the return on investment is also low. However, because savings accounts are low risk, you can be confident that you won't lose your money. Investments, on the other hand, offer the potential for higher returns, but also higher risk, as we said. The return on investments can vary widely depending on the investment vehicle and the market conditions at the time. For example, some stocks may provide a high ROI one year, but then lose value the next. So, really, I mean, again, it depends on your tolerance, your time, and all these factors that really affect the choices that you have to make. That is why financial planning is so important. I keep saying it because I really need to stress on its importance. Some things you'd need to consider before saving. When it comes to personal finance, it's important to have a plan in place for emergencies, short-term goals, and long-term goals. Understanding inflation and its impact on savings and investing is also crucial. Okay, so emergency funds are a crucial part of any financial plan. It's recommended to have at least 3 to 6 months of expenses saved up in case of unexpected events like job loss, illness, or major car repairs. Having that fund set up can help prevent the need to dip into long-term savings or go into debt. One way to start building an emergency fund is by opening a high-yield savings account. This type of savings account typically offers a higher interest rate than a traditional saving account, which can help money to grow faster. It's also important to prioritize saving for emergencies over investing, as emergency funds should be easily accessible and not subject to market fluctuations. You want to keep that money there and have it so that anytime you need it, you have access and it's not going to just deplete because of the environment or the markets changing. Because as we've said before in other videos, markets such as the stock market, they tend to be rather volatile. Things can swing left today and right tomorrow. So having that emergency fund there that's basically immune to all that's going on around it is a great idea and a great cushion for when you're making investments. Short-term goals. Short-term goals are typically financial objectives that can be accomplished within 1 to 3 years. Examples might include saving for a down payment on a home, a vacation, or a new car. When it comes to short-term goals, saving is usually the best option. Investing in the stock market can be risky and subject to volatility, which can impact the ability to reach the goal in the desired time frame. You're really going to have ups and downs that you're going to need to be continuously recovering from before your money really pushes up there. One way to save for short-term goals is by using a targeted savings account. These accounts are specifically designed to help individuals save for specific goals and often come with features like automatic transfers, goal tracking, and budgeting tools. I mean, this can be really helpful because sometimes you really need to see exactly where you're at, like one of those piggy banks where you can see exactly what line you need to reach and where you are. It's motivational, but it also gives you that assurance of, okay, I'm here, I need to be here, it's going as planned, I'm okay. Long-term goals, on the other hand, typically involve saving for retirement or major life events like a child's college education. With longer time horizons, investing can be a viable option for reaching these goals. Historically, the stock market has provided higher returns than traditional savings accounts, which can help money grow faster over time. And when it comes to long-term investing, again, it's important to have a diversified portfolio. This means investing in a mix of stocks, bonds, and other asset classes to help spread out risk. Working with a financial advisor can be a good way to get started with investing and ensure that the portfolio aligns with individual goals and risk tolerance. Definitely keep that in mind. Financial advisors can be great. Only thing you have to do is to make sure their fees are okay, something that you can afford, and ensure that your philosophies align as well, because they may have a different idea of how to go about investing and it doesn't really align with your goals. And so that's not going to work for you. So be mindful when getting a financial advisor. Inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and it can have a significant impact on investing or saving and investing. Over time, inflation can erode the value of money and reduce purchasing power. One way to combat the impact of inflation is by investing in assets that historically have provided returns that outpace inflation, such as stocks or real estate. It is important to regularly revisit financial goals and adjust savings and investment strategies as needed to account for changes in inflation rates. All right, so inflation, I mean, you can't really get away from it. However, you can do things to help ease that effect that inflation may have, right? Some factors you'd like to consider before investing. There's risk tolerance. We've spoken a lot about it, but let's look more into what it actually is. One of the most critical factors before investing is risk tolerance. This refers to an individual's ability to withstand potential losses from an investment. Some people are more comfortable with taking risks than others, and it's essential to determine one's risks before investing in any asset. Like I said, you don't want to invest in something. You invest in a business, and 2 months later, the business loses, but the money that you take to invest has had impact on your quality of life. That's definitely not what we want to do. We want to make sure that, should you lose, your quality of life is not greatly impacted. Okay? When it comes to investing, there is a direct correlation between risk and reward. Investments that carry higher risks also have the potential for higher returns, and investments that carry lower risks typically offer lower returns. Therefore, investors absolutely need to balance their risk tolerance with their investment goals to achieve their desired returns. The investment horizon. This is the length of time that an investor intends to hold on to an investment before selling it. The investment horizon is an essential factor to consider before investing because the types of assets may perform differently over various periods. For example, stocks are typically more volatile in the short term, but they may provide higher returns in the long term. Bonds, on the other hand, offer a more stable return, but with lower returns over the long term. And considering your investment horizon when investing is crucial. Younger investors may have a longer investment horizon, and they may be able to withstand short-term volatility in exchange for higher long-term returns. On the other hand, older investors with a shorter investment horizon may need to focus more on assets that offer lower risk and more stable returns. So you really need to, like I said, assess yourself, do your research, and implement these factors into your financial plan. Investment goals. Before investing, one should establish clear investment goals. Investment goals could include saving for retirement, buying a house, paying for college, even if you want to buy a skateboard because you're very young looking at this video and you just want to get on track to being able to save or invest. It doesn't matter what the goal is, as long as you have a goal. It's essential to determine the amount of money needed and the time frame for reaching that goal. Once these goals are clear, investors can develop an investment plan that aligns with their goals. You're not going to take on an investment that is going to pay out or reward you in 7 years, like a bond. You take out a bond with the government, and that maturity date is 7 years from now. But your financial goal is to send your child to school, and that happens in 5 years. You'll run 2 years short, and for that 2 year period, you'll absolutely struggle to send them where they need to go because you have undermined the process of creating that financial plan and sticking to it. So it's definitely important to recognize your investment goals. These goals are closely linked to risk tolerance and investment horizon. Okay, so they have an example. Someone saving for retirement may have a longer investment horizon and a higher risk tolerance than someone saving for a short-term goal like a down payment on a house. Okay, now we look at diversification. Diversification is a strategy that involves investing in different types of assets to reduce overall investment risk. A diversified portfolio may include a mix of stocks, bonds, real estate, and other asset classes or assets. By diversifying, investors can spread their risk across different asset classes, reducing the impact of any single investment's performance. Diversification can be accomplished in many ways. One way is to invest in mutual funds or exchange-traded funds, which offer instant diversification by investing in a basket of different assets. Another way to spread investments across is to spread them across different sectors, industries, or geographies. Telling you guys, diversify. Saving strategies. Creating a budget is a crucial step in financial planning. A budget helps you to track your expenses and ensure that you are not overspending. To create a budget, start by listing all your sources of income and your expenses, and this will give you a clear picture of your financial situation. It's not that difficult, right? Once you have that clear picture, you can start to make adjustments. Look for areas where you can reduce your spending, such as dining out or entertainment, or even if you pick up that more expensive piece of steak at the grocery store, just get the one that's a little less expensive. Save money, cut corners, do it any way that you can. It's important to be realistic when creating a budget, as you don't want to set goals that are impossible to achieve. For example, you make $9,000 a month. Let's just say you make $9,000 a month, but you spend $5,000 a month on bills. And you tell yourself, okay, listen, I'm not going to do anything else. Just my bills money, and that's it. That extra $4,000 is going directly into my saving. That's unrealistic because you're gonna end up going out some night for drinks or coffee, and it'll be outside of your expenses, and then you'll end up into a problem with your budget because now you're cutting in less than you budgeted for, and it's gonna be a mess. So be realistic, you know. Next, we have automatic saving plans. So moving on to the next thing, automatic savings plans. And automatic savings plans are an excellent way to save money without having to think about it. With automatic saving plans, a set amount of money is transferred from your checking account into your savings account each month. This can be a great way to build up your emergency fund or save for a specific goal, such as a down payment on a house. One of the benefits of automatic savings plans is that they help you develop good saving habits. By automating your savings, you make it a priority and ensure that it happens each month. It's not just left to people who particularly struggle to save money, or find it hard to stick to a budget to say, okay, let me take this amount of money this month and put it there. It's done for you. A lot of times it's done like just as you're paid so that you don't have the time to just take it all out, right? So it's a great option. Strategies for increasing savings. If you're looking to increase your savings, there are several strategies that you can use. One of the most effective ways to increase your savings is to reduce your expenses. Look for ways to cut back on your spending, such as canceling subscriptions or negotiating bills. All of us have that subscription that's running and we don't really use it. And we can do without it. So look at those. Another way to increase your savings is to find ways to earn more money. This could be through a side hustle or taking on overtime at work. Any extra income can be put towards your saving goals, and that could be the best thing that could happen. Finally, consider opening a high yield savings account. These accounts typically offer higher interest rates than traditional savings accounts, which means that your money will grow faster. We always hear about compound interest. So let's look at why we need compound interest. What is its importance? Compound interest is a powerful tool when it comes to saving and investing. It allows your money to grow exponentially over time. The key to compound interest is time. The longer you leave your money invested, the more it will grow. And that is why you need to get on saving immediately. It doesn't matter if you're 20, it doesn't matter if you're 18, you can start saving something. When you invest your money, it earns interest, which is added to your account. Over time, that interest earns more interest, which is also added to your account. And this continuous cycle goes on, and your money grows faster and faster as it goes, because obviously, if you're getting 5% on $100, and in 10 years, that $100 becomes $1 million, you're still getting 5% now of that million rather than the initial 100, right? So it's going to grow faster and faster every time. Compound interest can be particularly beneficial for retirement savings. By starting early and leaving your money invested for decades, you can build a significant nest egg for your golden years, right? It doesn't have to be investment, doesn't have to be done over a year or two. If you start early, it gives yourself much more room to make different decisions, investments, and take on more risk. Saving versus investing. Creating a budget, automatic saving plans, and strategies for increasing savings and compound interest are all essential components of a sound financial plan. However, it's important to understand the differences between saving and investing. Savings accounts are typically low risk, low reward options. They are a great place to store your emergency fund or short term saving goals, but that's what they're for. Investing, on the other hand, involves taking on more risk but potentially earning higher returns. If you're not sure how to invest, it's important to do your research and consider working with a financial advisor that meets your needs. They can help you to understand your risk tolerance and create a diversified investment portfolio to meet your financial goals. All right. Also, don't be afraid to check out our videos. We talk a lot about investing and which investments you can make and the risks associated and how you can mitigate those risks and find out if it's right for you. So jump on that. Saving and investing for short-term goals. Examples of short-term goals, right? Those are goals that you plan to achieve in a few months to a few years, and some of them include saving for a vacation or holiday, right? Who says you can't go to Fiji this year? Building an emergency fund, paying off credit card debt, purchasing a new car, or saving for a down payment on a house. Those are some examples. Best savings and investment options for short-term goals is what we're going to look at. And obviously, you need to take into consideration your financial goals and your risk tolerance and time horizon and find something that best aligns with that. But these are some of the best options for you. The savings account. One of the safest options for short-term savings is the savings account. A saving account provides a low-risk option with easy access to funds in case of an emergency. Many banks offer high-yield savings accounts that provide higher interest rates than traditional savings accounts. To maximize returns, look for savings accounts with competitive interest rates and low fees. Obviously, you'll have to look at if you need to have a certain amount of money to open that account, but that's another thing, right? The traditional ones, obviously, they don't require that. Money market account. A money market account is a type of savings account that typically provides higher interest rates than traditional savings accounts. Money market accounts may also have a higher minimum deposit requirement than savings accounts. These accounts usually require you to maintain a minimum balance, but in exchange, you can earn higher interest rates and have the ability to write checks. Big boy stuff, right? And then you have the CDs. A certificate of deposit is a savings product that typically offers a higher interest rate than traditional savings accounts. CDs have fixed terms ranging from a few months to a few years and offer higher interest rates than the longer the term. However, CDs typically have penalties for early withdrawal, so it's important to choose a term that aligns with your time horizon, because the time horizon is just the amount of time that you need or that you're giving yourself to fulfill your goals, right? So keep that in mind. It's a hand-for-hand thing. Treasury bills or T-bills. They are short-term investments issued by the US government. They typically have a maturity of 1 year or less and are considered one of the safest investments available. T-bills can be purchased directly from the US Treasury or through a broker, so you can look into those if you have those short-term investment goals. Corporate bonds. Corporate bonds are debt securities issued by corporations to raise capital. They typically have a maturity of 1 to 5 years and offer higher interest rates than savings accounts or CDs. However, they are not as safe as government securities and by default carry a higher risk. Now we spoke about what liquidity is. Now we need to look at its importance and safety. When it comes to short-term savings or investments, liquidity and safety should be your top priorities. Liquidity refers to how easily you can access your funds, while safety refers to the risk of losing your principal investment. For short-term goals, it's important to have easy access to your funds in case of an emergency. This is why savings accounts, money market accounts, and T-bills are popular options. These options offer liquidity and safety, so you can access your funds quickly without worrying about losing your principal investment. While corporate bonds may offer higher returns, they carry a higher risk of default and may not be the best option for short-term goals. It's important to carefully consider your risk tolerance and time horizon when choosing the right savings or investment option for your short-term goals. I mean, for any goal really, but you get the drift. In summary, when it comes to achieving short-term goals, it's important to choose the right savings or investment option that aligns with your goals, risk tolerance, and time horizon. Opt for options that offer liquidity and safety, such as the savings account or money market accounts and T-bills. With the right strategy, you can achieve your short-term goals and set yourself up for long-term financial success. Okay, it's all about that financial plan. It's kind of like balancing everything off. You can't want to go home and you're going to cook omelets, but you forgot to buy the eggs. They work hand in hand. So make sure that your financial plan is at the center of your investments. Now, saving and investing for long-term goals. Examples of some long-term goals are typically those that take more than 5 years to achieve, and these goals are usually require more significant amounts of money, making saving and investing crucial for achieving them. Examples of long-term goals include retirement, buying a home, paying for children's education, starting a business, traveling around the world. Not just a vacation, but that long-term kind of vacation, right? When it comes to saving for long-term goals, a savings account may not be the most efficient option. Savings accounts typically offer lower interest rates than other savings and investment options. To maximize your savings, consider the following options. High yield savings accounts. They offer higher interest rates than traditional savings accounts. These accounts are a great option for long-term goals that require large sums of money, such as a down payment on a house. High-yield savings accounts are also a low-risk option, making them ideal for those who are risk-averse. CDs. CDs are a savings option that typically offer higher interest rates than traditional savings accounts. They require a minimum deposit and have a fixed term, usually ranging from 3 months to 5 years. They're a great option for long-term goals as they provide guaranteed return on investment. And really, it is just a little extra push to keep that deposit going, that certificate of deposit going, because you know that there are penalties for removing your money early. So that encourages you to leave the money there and stick to your goals, of course. Then we have stocks and bonds. Investing in stocks and bonds can also be a good option for long-term goals. Stocks and bonds are riskier than savings accounts or CDs, but they offer the potential for higher returns. Investing in a diversified portfolio of stocks and bonds can help minimize risk while still providing potential returns. So, what is the importance of compounding? Well, first we need to understand exactly what compounding is. It is the process by which your investment earns interest, which is then reinvested, allowing your investment to grow over time. The longer your money is invested, the more time it has to compound. For long-term goals, compounding can be a powerful tool for building wealth. For example, let's say you invest $1,000 in a stock that earns an average annual return of 8%. After 1 year, your investment would be worth $1,080. After 5 years, it would be worth $1,469. After 10 years, it would be worth $2,159. The longer your money is invested, the more it can compound, resulting in significant returns over time. In conclusion, achieving long-term goals requires strategic savings and investment planning. High-yield savings accounts, CDs, stocks, and bonds are all viable options for long-term savings and investment. However, it's important to consider your risk tolerance and investment goals when deciding how to invest. Compounding is a powerful tool for building wealth over time, and it should be taken advantage of when saving for long-term goals. That is kind of just like multiplying your money. So now we're down to the nitty-gritty of it all. Choosing between saving and investing. Let's look at a few factors to consider. Okay, so whether you're trying to save or invest, there are several factors one should consider. And these factors would help an individual make informed decisions and determine which option is better suited for their financial goals. Remember, I said that financial plan needs to stay at the center, right? So obviously, we need to look at time horizon, which is important to consider when deciding between the saving and how long you need to save, how long you have Not exactly how long you should, but how long you have till that goal needs to become a reality, right? So if you know you're saving for a short-term goal, then a savings account may be the better option. But if you know you have time to get to that goal, then you can look at investing rather than saving, right? Because then you have more time to really take the reins on your investment, more time to play around, right? Then we look at risk tolerance. So obviously you'd have to know how much risk you can take. Some might not be comfortable with this and would go for something safer, like a saving account with the lower risks. However, if you have that risk tolerance there and you're backed with your emergency funds and everything, and you want to take more risk to get to those goals, then obviously investing may be the better option for you. So we know liquidity is the ease with which an individual can access their funds. Savings accounts, we know that gives high liquidity, so you can withdraw your money at any time. However, some investments may have restrictions on when an individual can withdraw, making them less liquid. Obviously, if you need access to your money at all times, you would go with saving. However, if you don't need to access that money, then investing is the better option, especially since those investment options usually deter you from removing money from your investment that easily. So it gives you a need to really just leave it there. The ROIs, return on investment, refers to, obviously, as we said, the amount of money an individual can expect to earn from their savings or investment. And this would more closely align with your investment goals in the sense that if you know you have little time to get to your goal, but you really need that higher return and you can take the risk, then you can go with an investment, or vice versa, you'd go with a savings account. How to create a balanced approach. Creating a balanced approach between savings and investing is crucial for long-term financial success. And here are some strategies we can look at to achieve this balance. Again, determine your financial goals. It's very important. It's essential, okay, to identify them, because then that will give you the timeline. Once you know your goals, then you know how long you have to achieve them. Then you create a budget from that. They help to identify the areas where you can cut back on expenses and allocate funds towards what's really important, which is your savings and investing accounts. Then we need to establish that emergency fund because we know that it's better to have that safety net there than to not have it, right? Explore the different investment options, right? There are lots of options available, like the stocks and mutual funds and real estate and all these things. Individuals should explore these options and determine which ones align with their financial goals and risk tolerance. You must maintain that diversified portfolio so that you can minimize losses and maximize returns. And that's just taking different classes of assets and putting them together so one doesn't affect the other, right? Not putting all your eggs in one basket. We have to remember the importance of flexibility. It's crucial when it comes to saving and investing. Financial goals always change over time, and that plan that you make, that financial plan, must always be revisited because throughout life things change, and those changes bring up about differences in risk tolerance. It may change your timeline that you're working with. You know, how can I say that? For example, you want to buy a house and your aim is to buy a house in 5 years. However, your wife just had babies and they can all stay in one room. However, you were expecting one child, she ended up with six, and now you need a bigger place faster than you did before. Your financial goal of obtaining that house has now changed, and thus your time horizon has changed. Your risk tolerance has changed because you have new responsibilities. Financial plans need to be revisited. Okay, let's look at common mistakes to avoid because obviously making wrong choices has severe consequences in some cases. So, not having that emergency fund, okay, not preparing for that can lead to debt. It can lead to higher interest loans and financial ruin, really. So the savings account is an excellent way to start building that fund. Like I said, putting all eggs in one basket. We don't want to not diversify. We need to diversify to make sure that if one asset class performs poorly, the others may still provide a return. Letting emotions drive investment decisions. We know how investing could be, that emotional roller coaster, sometimes fear, sometimes greed, and then you find yourself deciding all the things that don't even align with your plan. All right. No one can predict the market movements accurately. No one can tell you if this is absolutely 100% going to work out or not. But if you focus on your long-term goals and make regular investments, you can take a great approach to reassuring yourself and letting those emotions take over. Okay. Have a well thought out investment strategy and stick to it even during market volatility. Right? Don't see that stock plummeting and get scared because you're like, oh my God, no, it's going to go down, I'm going to lose all my money. Trust the research that you've done, trust yourself, trust the process, and wait and let it go up. Make that investment worth it, make it count. Timing the market. Timing the market is a common mistake. Okay, so moving on to timing the market. Timing the market is a common mistake that even experienced investors make. It refers to trying to buy and sell stocks based on market movement. However, no one can predict the market's movements accurately, and trying to time the market just leads to missed opportunities and losses. It's better to focus on long-term goals and make regular investments, right? So you probably looked at the video and understood everything that we've said and done, and you're asking yourself, should I seek professional help and when is that the best time to do? So, reasons to consult a financial advisor. They can be very helpful and help you make informed decisions about your savings and investment strategies. And some reasons to consider consulting a financial advisor include expert advice on saving and investing. A financial advisor can provide great advice on saving and investing. They can help individuals understand the different types of savings accounts and investment options available specifically to them, and as well guide on how to invest and save for both short-term and long-term goals. They can also help individuals create a personalized financial plan that takes into account their unique circumstances, such as their income, expenses, and financial goals. They can essentially help individuals establish a budget solely around their lives and create a savings plan that works specifically for them. They also help with managing individuals' investment portfolios by recommending appropriate investment options based on their risk tolerance and investment goals. They can also provide ongoing monitoring and advice on when to adjust the portfolio. Another thing they help with is retirement plans by calculating how much they will need to save and recommending appropriate retirement savings options such as 401k plans or individual retirement accounts, whatever is available to you. Tax planning is another thing that they're great at. They minimize their tax liability by recommending tax-efficient investment strategies and providing advice on tax planning. So really, even if you have an understanding of this document, but you still really need that push in implementing, they can really help with the implementation phase and cater it specifically for you. So that is absolutely a reason to seek a financial planner. So now you know, okay, maybe I need one. How do we find a reputable advisor? Finding one can be a daunting task. However, We have some tips on how to find reputable financial advisors. The first thing you do is ask for referrals. Your friends, family, close people, colleagues, anybody that really had any point to use one, they may have worked with one and can recommend a great financial planner for you. The next thing you want to do is not take anybody's word for it, but check their credentials. Look for advisors who are certified by reputable organizations such as the Certified Financial Planner Board of Standards or the National Association of Personal Financial Advisors. Check if they have any disciplinary actions against them. Anything that you can find to really verify their credentials, do that. Then you can use the internet and do some research online, check reviews and ratings on websites like Yelp, Google My Business, Angie's List, whatever you use. Then you can go a step further and interview potential advisors. Not because you found them and they work online and their portfolio seems great, you're not going to take a step into asking them about their sense of experience, speaking with them about their qualifications and their approach to financial planning. Just talk with anybody that you're interested in to see if they're really right for you. And last but not least, you should try to understand how they are paid. Don't skip that step. Some of them charge a fee for their services, while others earn commission on the financial products that they sell. So definitely find out exactly how they are paid. So the cost of financial advice, like we said, can vary in different ways. Some people ask for a fee only, some ask for commission-based, some do hybrids, but for fee-only financial advisors, they can charge a flat fee or hourly rate for their services. They don't earn commission from selling financial products. For commission-based, financial advisors earn commissions on the financial products that they sell, such as mutual funds or insurance policies. Fee-based financial advisors charge a combination of fees and commissions. And then we have asset under management or AUM. Those financial advisors manage an individual's investment portfolio and charge a percentage of the assets under management. It's important to understand how the financial advisor is paid and what services are included in their fees. Some financial advisors may offer a free initial consultation, while others may charge a fee for their first time. So definitely factor in that cost and see if it's right for your financial future. Balancing saving and investing, because we've spoken about the fact that you can have both, and there is an importance of having both. So when it comes to financial planning, the importance of both savings and investment cannot be overstated. Savings accounts provide a safe place to keep your money with low risk and easy access. On the other hand, investing can potentially yield higher returns over the long term, but comes with higher risk. Having both savings and investments can provide a balance that allows you to reach both your short-term and long-term financial goals. Savings accounts are great for short-term goals, but investing is ideal for longer-term goals, such as retirement. So some strategies that we have for balancing them. It's crucial to achieve the financial success that you want to achieve. And by balancing them, you're definitely on a better path to doing so. One popular strategy is the 50-30-20 rule, which recommends allocating 50% of your income to necessities, 30% to discretionary spending, and 20% to savings and investments. To balance savings and investing, you also need to consider setting specific goals for each. For example, you may want to save 3 to 6 months of living expenses in an emergency fund while investing in a certain percentage of your income. Investing a certain percentage of your income towards retirement. So that balance is crucial. You'd also need to revisit your financial plan regularly. I've stated this, it's essential. You cannot plan something now and then 2 wives, 3 kids later, God forbid, you're still using the same financial plan. It needs to keep up with your life and life changes. So in conclusion, this article has discussed the fundamental differences between savings and investment. Right? Savings is the money that you put aside for future use, but investing is the money you put to work to generate a return. We've discussed the types of savings and investment options, their pros and cons respectively, and explored their differences, including risk and reward, time horizons, liquidities, etc. We've also covered the key factors to consider before deciding between them, such as the emergency funds and your long-term or short-term goals, along with other things. We've discussed everything that you need to take that decision to the next step, to really verify if you need savings, investing, or if you can get to that point where you can balance both. The rest is really on you. It's never too early or too late to start saving and investing. Saving money is crucial to achieve financial stability, and investing is the key to building wealth. The earlier you start, the more time your money has to grow. Every dollar saved and invested today can become thousands of dollars in the future, thanks to the power of compound interest. If you're not sure where to start, there are many resources available to you to help you get started. You can consult with that financial advisor we spoke about, read books, browse websites, and use apps to learn how to invest and save money wisely. So please don't hesitate. It was great having you here today. Don't forget to hit that subscribe button and give a thumbs up if you really like the content. If you have any suggestions on future videos that you'd like us to do, please leave a comment down below, and you can check us out on our social media. We'll leave links in the description. Also, click that bell icon so that you stay updated when we post new videos, which happens basically twice every week. And take care, guys. I wish you luck on your investment journey and growing your financial portfolios. Take care till next time. Bye.